So you might be wondering, why am I recording this video if there's only $34 of monthly passive income? But we're gonna um, follow the principles, make the video when I place a trade, so then you have a good, transparent understanding of what happens when you take too much risk when it comes to using this strategy. And this is actually what I predicted. Um, but let's go through the trade. So my AEM options got exercised. And then right now I'm selling a cover call, strike 55. Premium earned per contract is $34, which is really low. So if you look at the capital use, let me just eliminate this part because it's not correct, is actually $6,000. So here you will see it's actually the correct number. And the return is 0.57% for 42 days. So roughly the prorated annualized return is 4.92%, which is below the 30% mark. So then you might be wondering, this is a shit trade. Why do you have to do it? And the reason is because when you're looking at the wheel, you need to generate income on both sides. So when you're selling the puts, you generate income, of course. When you're selling the cover call, you're also generating the income. But what happens when the stock goes against you significantly, like down 10% or whatnot? And this is a perfect example of the cover call giving you a very low return. So let me go to the monthly tracking sheet, which you can get access to in the description below. And the way you look at AEM is you need to put these two trades together. So in the very beginning, December, I made 6% from AEM. So this is a realized return. And then afterwards, now I'm making 0.57%. So AEM as a position in total is 6.72% at the moment. So when you think about that across 2 months, it is still not bad, I would say, but it's definitely not fantastic in the sense where previously you can see that trades are making like 5% or 3% per month. So then once the strike versus the um, current stock price is way out of the money, then you can see the return decreases drastically. So that means when you're executing this strategy, you actually need to be very careful when it comes to picking your strike price. You can't just like randomly pick a high strike price because it offers you a higher return, because there is the downside. So here you can see it is a medium risk position where it got exercised. So then you can look at these medium risk, high risk positions where technically speaking, I'm getting burnt for it. So if you look at the big picture and let's say AEM stock price just remains the same for the next 11 months or so, then in total, my return will still be approximately 11% from this stock, even without the stock price moving. So that is the theory behind using the wheel. But of course, if the stock price continues to go down, then the strike price for the cover call needs to be adjusted. So then it would actually lower this return further. So I actually don't think if you continue to sell cover call and the stock price doesn't move in your favor or it's moving against you, then you would need to take more risk or even potentially a loss as well. So yeah, that's actually one of the downsides for cover call. So then that means when you're doing the wheel, you need to be right. If you're wrong and you do the wheel, you will still get a low return. So I think there's a lot of misconception thinking that using the wheel, you can, be more relaxed and you don't need to be right. But I don't think that is actually true. In fact, whether you use call options or you use the wheel, you both need to be right. So that means you need to do your due diligence. You need to not take too much risk, or else your return will be lower than average.